Here in the last couple of months, it seems the only direction that stocks are going is down. And this has a lot of people stressed out. They're looking at their portfolios, seeing all the red. They don't know what's going on, but I'm seeing sales going on. I'm seeing discounts, and it is making me excited to see some of these prices. Hello everybody, it's Tortoise Investing coming at you today with 3 dividend stocks that you can buy and hold forever. These 3 are down this year and down pretty huge. A lot of things are down. Interest rates higher for longer fears have drove a lot of these stocks just plummeting, especially REITs, real estate investment trusts, are suffering super hard right now. I went over that in a video. Extra space storage down 25% year to date. I released this yesterday, so if you haven't, go over, check it out. Short and sweet, 3 minutes long. I did some new editing thing with it. Check it out. Hit the like button on it. Like this video. Subscribe if you're new. None of this financial advice, but yeah, let's go ahead and take a look at the portfolio. Before we dive into everything, again, I'm going to be super transparent with this. I'm never going to hide this from you. This is how everything is looking. I'm down big on extra space storage and Hershey right now, but I'm just buying more. The more it drops, the more I buy. I think that these are going to turn around for me, and being iron hand with them is going to pay off in the long run. Now, Home Depot, one of the leaders in the home improvement sector, being impacted by theft here lately, and a lot of retailers have been struggling with this, which has led to the stocks dropping like a rock. Home Depot has an adjusted free cash flow yield of 5.65%, a dividend yield of 2.93%, payout ratio 51%. This thing was hovering around 330, now down to it's below 280 right now, down 16% since September 1st. Take a look at the revenue. Revenue's been increasing at a rate of 9.3% over the last 5 years. Very nice. Free cash flow has been increasing at a rate of 7.34% over the last 10 years. And we look at it at a per share basis. They buy back their shares. So free cash flow per share, 11.53% increase over the last 10 years. Very nice. This company does share buybacks, and I love that. EPS growing at a rate of 18.72% over the last 10 years. Debt, they do have some debt at $41 billion as of last year. But they're, no, not last year, this year, $41 billion, that's updated. And the EBITDA this year, $27 billion. So my rule of thumb is I don't like companies that have 3 times or more than their EBITDA in debt. So this one's definitely okay. Their financial sheet looks good to me. The dividend's been increasing at a rate of 18.28% over the last 10 years. Their last hike coming in at 10%. So still nice double-digit compound growth. And shares outstanding, been buying back shares at a rate of 3.81% over the last 10 years, and still over the last year over 3%, right in line with that. So they are just gobbling up shares. Love it. Return on capital employed has been above 30, 40, 50 area for forever and a day. Love that. Next up, Texas Instruments, one of the many companies in the semiconductor industry, and if you've used any of their TI calculators during calculus, you know what I'm talking about. Down from their quarterly report, their earnings has made them drop a little bit. Adjusted free cash flow yield of 1.94%, dividend yield 3.54%, payout ratio 58%. Now, they are down big here as of late. They were at a recent high on July 25th of 186. They are now down 24.49%. Big drop. Revenue's been increasing at a rate of 6% over the last 5 years. Free cash flow has been increasing at a rate of 7.33% over the last 10 years. Look at it at a free cash flow per share basis, right at 10%, 9.55%. That's what you like to see. Means they're also buying back shares. EPS has been growing at a rate of 20% over the last 10 years. Beautiful. They have more cash than debt on hand, so debt is not an issue with this company. Love that a lot. The dividend's been increasing at a rate of 16.59% over the last 10 years. Their last hike came in not all that big, but that's okay. Still growing. And shares outstanding have been decreasing at a rate of 2% over the last 10 years. Very, very nice. And Again, return on capital employed since 2014 has been above 26%. And here lately, it's been the 30s and 40s. So excellent, excellent. Love to see that. Next up, we have Vich Properties, one of the top real estate investment trusts in the gaming sector. Adjusted free cash flow yield of 7.26%, dividend yield of 5.94%. We're not going to pay attention to payout ratio because they use funds from operations. REITs are taxed differently. Do your own research and stuff before investing into REITs or really any of these. Vici is down as well year to date. They had their recent high back in April 28th. They are down 18.33%. Revenue and everything is just going to look bonkers here. 66% growth. Free cash flow, 71.8% growth. Their dividend has been increasing around 7% every year, 7 to 8%. And for something that's got a yield this high, almost 6% dividend yield, that is fantastic. Again, a lot of REITs are beat up. REITs carry a lot of debt. That's how they do acquisitions, buy new properties and stuff. But yeah, these are three big name industries. I like all of these. I love me some Home Depot right now. But yeah, hope you've enjoyed that. Make sure to hit that like button and subscribe for more. I greatly appreciate it. And until next time, see yous.